Welcome back, everybody. So this is actually going to be my last video for 2023, and we'll get to that at the end, but there's a lot to talk about to wrap up the year, including Jerome Powell in the FOMC meeting last week that sent markets up because they're planning to cut rates. Or are they? We're going to break it all down. As well as some thoughts on the Epic Games and Google App Store antitrust suit. And lastly, we'll talk about what you can expect from this channel in 2024. We have a ton to get to, so let's get started. Now, first off, a lot of the market news last week was around the Federal Reserve and their decision to keep rates the same. Well, actually, that really wasn't what people were talking about at all, because we all kind of guessed that that's what they would do. But what got the market excited was the Fed signaling that there may be rate cuts in 2024. Now, if you remember, just a few weeks ago, I was saying that the words coming out of Jerome Powell's mouth kind of indicated that they weren't even thinking about rate cuts yet. And this is what he said back on November 1st.
The fact is, the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts. We're still very focused on the first question, which is, have we achieved a stance of monetary policy that's sufficiently restrictive to bring inflation down to 2% over time, sustainably? That is the question we're focusing on.
But then this is what he said last week.
When it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question. And that's what people are thinking about and talking about. And I would just say this: we are seeing strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature, and we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not. That's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
And just real quick, anytime he says begin dialing back the amount of policy restraint in place, he's basically talking about cutting rates. Policy restraint is when they raise rates for the most part, and dialing back on policy restraint is when they lower rates for the most part. Now, why they can't just speak English, I don't know. But let's listen to this last piece to see his view on what the projections are.
So in looking at the different components of the data, how much closer do you have to get to 2% before you consider cutting rates?
I mean, the reason you wouldn't wait to get to 2% to cut rates is that policy would be too late. I mean, you'd want to be reducing restriction on the economy well before 2%, because before you get to 2%, so you don't overshoot. If we think of restrictive policy as weighing on economic activity, it takes a while for policy to get into the economy, affect economic activity, and affect inflation. So I can't give you a precise answer, but if you look at what's in the SEP, and I think you'll see a reasonable estimate of the time lags and things like that it would take.
He really didn't say anything specifically about cutting rates. All he said was they're starting to think about it and reference the SEP for our projections. And you're probably like, what is the SEP? Well, the SEP is a summary of economic projections that the FOMC participants put together, which is their own anonymized personal projections that are then aggregated and released to the public. So let's take a look at it. You can see that their projections over the next 3 years is to get inflation down to 2%. And included in this is our overall projections for the federal funds rate during that time. So starting at 5.4, going all the way down to 2.9 in 2026. And if we scroll down to the dot plot, we can see that for 2024, most of the FOMC participants believe that the federal funds rate will be brought down somewhere between 4.25% to 5% over the next year. So what does this actually mean? Well, first off, it means that pretty much all of them believe that at this point, the worst is behind us and additional rate hikes are not likely to happen. And you can see this because no one is predicting rate increases at this point. But it also means that most of them believe the journey to get back down to a lower federal funds rate will start next year. But it's all based on what we know and see today. Because if the economic data starts to change or take a turn for the worse, then all bets are off. But let's take a look at how this is actually being reported, because to me, this is where it gets confusing for investors. Now, if you look at the CNBC headline, it says that the Fed indicates 3 rate cuts. But remember, in the press conference, Jerome Powell never actually says that. And so here's how they got there. They assume that each cut is a 0.25% cut, and the projection goes from 5.4% to 4.6%, which is roughly 3.25% cuts. And they project another 4 cuts in 2025 since it goes down a full percentage point. Now, personally, I don't think the CNBC headline is really all that bad, and they actually explain to you in the article how they got there. In other places, not so much, because you see things like market pricing in cuts as early as March, markets soar because of rate cuts, and this one to me is the worst. U.S. stocks soar after the Fed indicates at least 3 rate cuts in 2024, and I'm sorry, but that's just blatantly wrong. And then there's this one where Jim Cramer dismisses recession fears, so of course, we all know that means that the recession is probably going to hit starting next week. So the reporting that's been done compared to what Jerome Powell actually said and what the Fed actually released, to me, has gone a little bit too far. And the market obviously is forward-looking, so I think that rate cuts on some level are already kind of priced in. And even a couple of the articles that have come out over the past couple of days after the FOMC meeting make it seem like some of the Fed representatives are trying to walk back a little of the excitement. You have Raphael Bostic saying that 2 rate cuts in 2024 is about what he expects. And then you have the Fed's John Williams basically saying that they're not even really talking about rate cuts right now. So again, if you follow any of this financial news on a regular basis, it can be really confusing with all the mixed messages that you're getting. And especially when you see headlines like this that can cause people to have FOMO, and that's really a dangerous thing. So what can we actually take from this, and what should we be doing about it? Now, the reality is that the market may already be pricing in something that isn't guaranteed. It's just a projection. But this is why I don't try to predict macro stuff really at all, because there's just no way to know for sure. And making decisions based on that isn't how I want to invest. So for me, I just look for value in quality companies consistently, regardless of what's happening from a macro perspective. But let's just take this at face value. Let's say the Fed does have 3 rate cuts next year. That would bring the federal funds rate down from about 5.4% to around 4.6%. Is there any stock that you want to buy where you think it's not attractive with the rates at 5.4, but it is attractive with the rates at 4.6? I mean, probably not, right? So what really is the difference? At the end of the day, what still matters is the fundamentals and future prospects of the business that you want to buy shares in. So in my opinion, the macro news is really just noise, and we should focus on the individual research that we're putting into these companies, and we'll be fine long term. At least that's the approach that I'm taking anyway. Okay, so next up, Google was in the news this week because of their antitrust suit with Epic Games, the maker of Fortnite. Now basically, Epic Games contended that Google maintained an illegal monopoly in the Android app market over both app distribution and in-app payment processing, where fees can take up to a 30% cut of every payment made. In this case, a jury sided with Epic Games after only 3 hours of deliberation. But Epic didn't actually ask for monetary damages. Instead, they wanted a court order to rewrite how Google operates the Play Store. Now, obviously, we won't know the impact of this until we get that future ruling by the judge, but it brought up a bunch of interesting questions about Google and how they operate their Play Store, which obviously brought up questions about Apple, and people wondering if this is going to impact Apple in the future. Well, actually, Epic Games already had an antitrust suit against Apple, which they lost. And the main differences came down to 2 things. 1, it wasn't a jury trial at all, so it was decided by a judge. And 2, it really hinged on the fact that Apple doesn't allow any other app stores on their platform other than their own. Now, the fact that Google allows other app stores on their platform and we're incentivizing major game makers to not create their own with revenue sharing deals really made it a different situation. So no, I don't think this particular issue is actually going to impact Apple because they've kind of already been through it. But overall, here's my thoughts on the situation. Imagine that you create a product and you want to get it in front of the best possible audience. If you want to get it into a Walmart or some other big retailer, you might pay what they call a slotting fee, which basically a cost to get your product in front of the customers you want. Now, to me, Apple and Google have built that, but just in a digital form. You can create your own app on a mobile browser if you want, if you don't want to deal with that fee, and that's a choice you have to make as a business. And I know people will say that these are the 2 dominant mobile platforms in the world, and that gives them an unfair advantage, but I just look at it as if you want to get in front of the best customers, this is the fee you have to pay, even though you may not like it. Now, I'm also an investor in Apple, so I'm probably biased. All right, so lastly, this is going to be my last video of 2023. And the main reason is I want to go spend some time with my family, enjoy the holidays, and deal with all the craziness that comes around this time of year. But I also plan to work on the site and build Invest Live as a business a little bit more. And being that most of my week is usually spent making videos, it'll be really nice to have a little bit of time where I can focus a little bit deeper on other things. But in terms of this channel, even though I started it in 2022, it really started showing signs of life this year. I've mentioned multiple times that we were around 900 subs just in July. So to be at the end of the year close to 18,000 is just insane to me. Being able to interact with you guys, learn from your comments, and have a little bit of fun as we all learn more about stocks and investing has been something that I've really enjoyed. And it's been an awesome ride so far, and I'm excited to see where we're going to be at a year from now. So in terms of what you can expect from this channel in 2024, obviously there's going to be more videos, and I'm working to figure out how I can get back to 3 videos a week, so we'll see about that. But also expect a lot going on with my new weekly newsletter, as well as buildinvestlive.com. The idea is to build it into the absolute best place to learn about stocks and investing for folks who want a little more and like the style and perspective we have here on the YouTube channel. But look, above all else, as we get closer to the end of the year, it's natural to kind of look back, especially when it comes to investing, and scrutinize the things that you've done. You know, maybe you didn't buy that thing that you should have, or you sold something too quickly that you wish you hadn't. But whatever you do, don't get too caught up in those things, because at the end of the day, investing really isn't about this, or even this. It's about things like this, or like that, or even this. And I genuinely hope you get to spend a lot of quality time with your loved ones over the next couple weeks, because really, that's what it's about. Now, I hope you guys have a very Merry Christmas, or Happy Holidays, or whatever you celebrate, and a happy, healthy, and most importantly, safe New Year's. And I'll see you guys back here in 2024. Thanks for watching. A lot more to come. I'll see y'all later. Peace.